Hello, I'm Edward Sterling, macro analyst for Bulwark Bullion. If you're new to investing in gold and silver, the market can look surprisingly simple at first glance. Gold has a price. Silver has a price. You buy some coins or bars, store them somewhere safe, and wait for the price to go up. But that simple picture hides something important. Gold and silver don't behave like typical commodities. They're not driven purely by supply and demand the way oil or copper might be. Instead, precious metals sit at the intersection of monetary policy, currency markets, real interest rates, and investor psychology. That's why understanding how to invest in gold and silver requires looking beyond the price chart. So in this video, we're going to walk through a beginner's guide to investing in gold and silver. But more importantly, we're going to look at the deeper macro forces that actually drive these markets and how investors think about precious metals within a broader portfolio. Let's start with the most basic question. Why do investors buy gold and silver in the first place? For thousands of years, these metals have served as money. Long before modern financial systems existed, gold and silver were widely used as stores of value because they were scarce, durable, and difficult to produce. But in the modern financial system, their role has evolved. Today, investors typically buy precious metals for three primary macro reasons. The first is protection against currency debasement. When governments and central banks expand the money supply aggressively, the purchasing power of fiat currencies can decline over time. Precious metals, which cannot be printed or created through monetary policy, often attract investors looking to protect long-term purchasing power. The second reason is financial stability. During periods of economic stress, banking crises, or geopolitical uncertainty, investors often rotate capital into assets perceived as safe havens. Gold, in particular, has historically attracted strong inflows during these risk-off environments. And the third major driver is real interest rates. This is one of the most important forces shaping the gold market, yet it's often misunderstood by new investors. Real interest rates refer to the return investors receive after adjusting for inflation. When real yields rise, investors can earn stronger inflation-adjusted returns by holding government bonds or cash-like assets. In that environment, gold becomes less attractive because it does not generate income. But when real yields fall, the opportunity cost of holding gold declines. And that's often when precious metals begin to perform well. In other words, the gold market is deeply tied to what's happening in the bond market. Before we go further, if you're enjoying this breakdown of the precious metals market, make sure to hit the like button and subscribe to the channel. Now let's talk about something beginners often miss. Gold and silver may both be precious metals, but they behave very differently. Gold is primarily a monetary asset. Its price is closely linked to macroeconomic variables like real interest rates, central bank policy, and currency movements. Silver, on the other hand, is a hybrid metal. Part of its demand comes from investors seeking monetary protection, similar to gold. But a large portion of silver demand comes from industry. It's widely used in electronics, solar panels, and industrial manufacturing. Because of that industrial component, silver tends to behave differently during economic cycles. During periods of strong economic growth and rising commodity demand, silver often outperforms gold. But during economic slowdowns or financial stress, silver can sometimes fall more sharply because industrial demand weakens. One way investors track this relationship is through the gold-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. When the ratio rises significantly, it often signals economic stress or strong demand for gold as a safe haven. When the ratio falls, it usually reflects stronger economic conditions and rising investor demand for silver. It's one of the most closely watched indicators in the precious metals market. Now, once investors decide they want exposure to gold or silver, the next question becomes practical. How do you actually invest in these metals? There are three primary approaches. The first is physical ownership. This includes gold coins, gold bars, silver coins, and silver bullion. Many investors prefer physical metals because they eliminate counterparty risk. When you hold the metal directly, you are not relying on a financial institution or intermediary. But physical ownership comes with costs and considerations. Dealer premiums, bid-ask spreads, storage, and insurance can all affect your overall return. Coins often carry higher premiums than bars, particularly government-minted coins like American Eagles or Canadian Maple Leafs, because of their recognizability and liquidity. Silver premiums can also be significantly higher than gold premiums because silver has a lower value per ounce, which increases handling and distribution costs. These are practical realities that investors need to understand before entering the physical market. The second option is exchange-traded funds. Gold and silver ETFs allow investors to gain exposure to metal prices without taking physical delivery. These funds trade like stocks and closely track the price of the underlying metal. For many investors, ETFs provide convenience and liquidity, but they also introduce management fees and counterparty exposure. Investors are relying on the structure of the fund rather than holding the metal directly. The third option is mining stocks. Gold and silver mining companies often provide leveraged exposure to metal prices. When gold prices rise, mining company profits can increase faster because production costs tend to remain relatively stable. However, mining stocks behave more like equities than precious metals. They are influenced by operational risks, management decisions, and broader stock market sentiment. During equity market downturns, mining stocks can decline even when gold itself is relatively stable. So the choice between physical metals, ETFs, and mining companies ultimately depends on the role you want precious metals to play in your portfolio. Which brings us to another important question beginners often ask. How much gold or silver should an investor own? There's no universal answer, but many portfolio managers view precious metals as a form of diversification or financial insurance. A common framework is allocating somewhere between 5 and 10% of a portfolio to precious metals. The goal is not necessarily aggressive growth, but rather protection against macro risks like inflation, currency instability, or financial crises. Now here's where the broader macro environment becomes critical. Gold and silver rarely move in isolation. Their price trends are closely tied to several key indicators: the US dollar, treasury yields, real interest rates, inflation expectations, and central bank policy. When the dollar strengthens sharply, it often puts downward pressure on precious metals because gold is priced globally in dollars. When the dollar weakens, metals often benefit. Similarly, rising real yields tend to create headwinds for gold, while falling real yields can support higher metal prices. Over the years, I've noticed that precious metals rarely move because of a single factor. More often, they respond to several macro forces shifting at the same time. Changes in interest rates, currency movements, inflation expectations, and investor sentiment. That's when these markets really start to move. And that leads to the bigger picture. Precious metals tend to perform best in specific macro environments. They often thrive during periods of falling real interest rates, aggressive monetary expansion, currency weakness, or financial instability. In other words, gold and silver tend to shine when confidence in traditional financial assets begins to weaken. That's why these metals have remained relevant for thousands of years. Not because they produce income, but because they represent a form of financial insurance when the broader monetary system faces stress. Which raises an important question. If global debt continues rising and central banks remain deeply involved in financial markets, will precious metals become more important in the years ahead? Thanks for watching. If you're interested in gold, silver, and the macro forces driving global markets, make sure to like the video and subscribe. For more analysis, visit bulwarkbullion.com. I'm Edward Sterling, macro analyst for Bulwark Bullion. See you in the next one.